Hey guys, in this video, I'm going to be sharing with us the one strategy that will be of benefit to us as a forex trader. My name is F. Evans, and here on YouTube, I'm a Spirit Trader. I am a forex trader. So let's head over to the strategy. The strategy is no other strategy but ICT fair value gap. Now, this strategy involves three consecutive candles. I'm going to be sharing with us the example in my chart right here on trading view. Now we're going to pick a fair value gap here, which is 1, 2, and 3. So the first candle, the second candle, and the third candle. Now if you watch carefully, the first, the second, and the second candle has no candle at the middle, so it's one long candle, which is this very one right here. Now every time you see this candle at the middle having a very large space, it is called a fair value gap. Fair value gap meaning prior to this move up, there were only sell delivery to the downside. From the very first candle to the second and to the third, they are only sell delivery to the downside. So price needs to come at least to touch the midpoint of here to offer fair value. Now, how does this strategy actually works? So every time you see the first, the second, and the third candle, all you need to do is just to take a 2 here. All you have to do is to take your 2 here, which is called the rectangle 2. The rectangle 2. So all you have to do is to take a 2, which is called the rectangle 2. And mind you, I'm doing my analysis on trading view. So please, if you don't have trading view, just go ahead to Play Store if you're using your mobile phone, or you download it on your system if you're having a laptop or a computer. But now I'm using my phone for this tutorial. So you pick a rectangle 2. Remember, it's 3 candles. The midpoint, you start from the first candle that starts the fair value gap. You pick the low of that candle and draw it to the high of the third candle. So from the low of the candle, from the very first candle to the high of the third candle. So 3 candles constitute this strategy. So now, what kind of fair value gap is this? We have 2 kinds of fair value gap. We have a sell fair value gap and a buy fair value gap. If you watch all these right here, now in my trading view, my sell is black candle, while my buy is ash candle. So price was moving down all the way here before it moved up. So we have a bearish fair value gap and also a bullish fair value gap. But for this example, I'm using a bearish fair value gap. So now we understand that a fair value gap is constituted by 3 candles: the first, the second, and the third. The second candle usually constitutes the fair value gap. That is where the fair value gap is. So now, prior to this up move here, we have this down move. So price will need to go to at least the midpoint to offer fair value. Now, let me explain the most important points of a fair value gap. Now, if you watch carefully in this fair value gap, you find out that in the midpoint, which is this place right here, you find out that this first candle, this second candle, and this third candle, the bodies are staying below the midpoint of the fair value gap. This is very crucial and very important for a fair value gap. Now, how do we know when a fair value gap will work? How do we know that a fair value gap, when it comes to the fair value gap, is going to sell off? Anytime you have price trading back to the fair value gap, in this case, price was trading back inside the second candle, you have to watch the bodies, what the bodies are doing at the consequent encroachment, which is the midpoint of a fair value gap. Now, if you watch carefully, the body of the first, the body of the second, and the body of the third candle inside of this fair value gap stayed below the midpoint of that fair value gap. It is very, very important. So how do I know that when price gets to the midpoint, it's going to sell off? How do I know that when price gets to the midpoint, it's going to be heavy to the downside? I have to watch what the bodies were doing at the midpoint. Very, very important. Very, very crucial. So now, before this large drop to the downside, before price traded to the fair value gap, if you watch here, price took a form of buy side liquidity. I'm going to be doing a video on understanding buy side liquidity and sell side liquidity. Price took a form of buy side liquidity here. That means, what that simply means is that price went up and swept this high. So when price went up and swept this high, we had a very large drop, a very large drop to the downside, a very large drop to the downside, which implies that the market has not turned. Now, if you watch carefully also, these equal lows right here, all this sell side liquidity right here, were also taken by this drop. So according to ICT, we have a shift in market structure right here, a shift in market structure right here. So we had a shift in market structure right here. Now, when price went down aggressively to the downside, which implies that the algorithm is now firing in sales position. Now, this is not referring to the fact that there are sellers in the market. The algorithm is just offering sell side delivery. So once we had this shift in market structure right here, all we have to do is to wait for price to go to the fair value gap. Now, if I take a fib 2 right here, the Fibonacci 2 right here, and I take it from this big drop to this place, on the highest high to the lowest low, if you watch carefully, the red line, which is the midpoint of the Fibonacci, is also tallying with the midpoint of this fair value gap. This is a very, very A plus setup, a very, very nice setup. So once price shifted to the downside, which means we had a shift in market structure, price went up, retraced back to what? Retraced back to the midpoint of the Fibonacci, and also the midpoint of what? The fair value gap. This right here is actually a daily range. The Fibonacci from the highest high, this highest high here, to the lowest low is a daily range. What is a daily range? A daily range is simply when price takes both buy side and sell side. So price first of all took buy side here, then price took sell side here. So we have ourselves a daily range. So now price returns back to the consequent encroachment. So we had the first, the second, and the third. Now, if you watch carefully, a swing high was also formed right there. A swing high was also formed right here. One, the very highest one and the low one here. So this is a swing high. So we don't expect price to take this high again, and the bodies are already telling us the narrative in this fair value gap. So now what do we do? All we have to do is to move over to a lower time frame. In case you are scared of not taking this trade, we move over to a smaller time frame. So now let's move over to the 5 minutes. If I move to the 5 minutes, you see carefully that we had two fair value gaps on the 5 minutes. We had this one and this one, two consecutive fair value gaps, but we have refined it in the 15 minutes time frame. So now you can see also here that the bodies in the 5 minutes were also resting or staying below the lower half of the fair value gap, which is also very, very important. So now if I move over to the 1 minute, you see something that is going to pan out. Now I actually took this trade on my account, but as at the time of this trade, I took the trade. Now if you watch carefully on the 1 minute after the big drop, what price did on the 1 minute in the inside the 15 minutes fair value gap was that price took this high right here. Price took that high right there. This also what a sweep of liquidity. Now price is fractal. That means everything you see happening in the 15 minutes can also happen in the 5 minutes, in the 1 minute, because price is the same. So now price also had to sweep liquidity right here. And what do we have? We have a shift also in market structure right here. A shift in market structure. Then we had a sweep in liquidity, shift in market structure. Right here is where you have the setup. This is an A plus setup. Amazing setup. So price after the shift in market structure on the M1, after we have already reacted on the 15 minutes fair value gap CB, which is sell side imbalance, buy side inefficiency, we went higher to the fair value gap also created on the M1. And this is very important. Now if you watch very closely right here, very closely right here, you find out that the bodies of the candle in the M1 also were resting below the upper level, below the upper level of this fair value gap, which is also a CB on the M1. So price was also resting below. Watch very carefully. Look at where the bodies were resting. The bodies were resting below the midpoint, which is the consequent encroachment. The midpoint, watch this, the midpoint of the fair value gap created on the 1 minute time frame. So now this is your entry. Once price begins to show you this narrative on the M1, the fair value gap created on the M1 inside of the 15 minutes fair value gap, after you have had a sweep of liquidity and a shift in market structure, all you need to do is just to place a sell, because everything is now in place. Everything is now in place. You place your sell position right here and you put your stop loss above the fair value gap created. Amazing. Now let me check the pips entry from this place as it touched the consequent encroachment is 14 pips. Amazing price delivery. And if you watch carefully, price was so heavy to the downside. Because why? Price has already shown us everything from the 15 minutes to the 5 minutes and to the 1 minute. Now where should we target? There's a near sell side liquidity here, which is that swing low created on the 5 minutes. This is your sell side liquidity for target. sell side liquidity for targets. So this is your setup, and this is how to treat a fair value gap. Now this setup is so amazing. If you can wait for this setup every single day on the pair you trade, now it might not happen every single day in your pair that you trade, but if you can happen to see this setup in the pair that you trade, this setup is amazing. This setup can make you a profitable trader. Now, it doesn't mean that you're not going to take losses. You're going to take losses, but this setup is so amazing. If you can wait for it and allow price to give it to you, don't chase price. You allow price to bring the setup to you, then you trade it. I'm going to be doing further videos on explaining in depth how to trade fair value gaps, both for the downward fair value gap and for the upward fair value gap, which is actually called, the downward fair value gap is actually called CB, which is sell side imbalance, buy side inefficiency. Why for the upward fair value gap is actually called BC, which is buy side imbalance, sell side inefficiency, and all of it were coined by no other person but ICT. Shout out to ICT in this video. He's my mentor and he's the one that I learned SMC from. I respect him so much. So now this is just an introduction to learning how fair value gap works and the fractal movement of fair value gap from both the higher time frame to the lower time frame, because price is fractal. Price is always referring to everything from the lower time frame to the higher time frame. So this is how to trade, or this is an introduction to trading fair value gap and the power of fair value gap. See you in the next video and see you in depth on how to trade more about fair value gap. Thank you very much for watching. I really do appreciate it. Thank you.